Okay. Hello, everybody. Happy Monday. We are June the 2nd, 2025. So, I am live on Facebook. So, I am committed to continuing to do this because I realize that there's lots of people who actually get a lot of great value out of this. So, thank you for your continued support. So, I am your host, Hong Lu. I am with Cash Property. And today we're going to be talking about equity. Now, not just equity, but what equity is. And this is a common question that I get from fellow investors who are just starting out saying, "What? Of course I have equity in my home, Hong. Like, what are you talking about?" And then we run through the scenario, and it turns out that they have no equity at all, and which is a sad position to be in. So we're going to talk quite a bit about equity. As much as I can show you in 30 minutes, we'll go through a calculation on how to figure that out and what to do with some of that lazy equity. And the reason why this is important is because once you have some properties under your belt, if you're not using that equity, then it's lazy equity. And it becomes just one of those things where then you're not growing your portfolio, you're not growing your net worth. And so it's definitely worth taking a look at. So we will get into that. Now, before we do, there's a couple of things that I need to just mention. One is the disclaimer. Please double check the content with somebody else. I do this for fun and to help fellow investors grow their net worth and their money so that they can have time with their family and friends. And it might not be the right advice for you. So take it with a grain of salt. Definitely go get some help before you go and implement any of it. So let's see here. So I do want to share a couple of exciting things. So it's already been a couple weeks, but we do have a couple of amazing things that we're doing. The first thing is this video that I want to share because one of our raffle winners actually won $500. Okay, so let me share this quick video. This is what $500 looks like. All right, so congratulations to our $500 winner. And yeah, I think that's already been sent over. So hopefully they are enjoying that cash and hopefully that video thing worked. All right, and then let me just go into the next great thing and this is something that I'm super proud about. So on the screen, you'll see a website for Freedom Tree. And at that event, I actually made a promise to match all donations made to Freedom Tree up to $10,000. And I'm sharing that because this is one of the first times I'm doing such a big donation. And I'm super happy to be able to do such a donation match for a nonprofit organization like this because one, I'm giving back to our community and our world, but also it really one of the things that it really helped me do after making this donation was that it really motivated me to be like, hey, you know what, Hong, it's okay for you to make more money in real estate. It's okay for you to create your fund and make money off of that because when you do stuff like this where you make donations to organizations you support that help other people in the world. And so it really gave me like a lot of like goosebumps to be able to do that. And so I'm sharing this because one, if you are in that generous mood of wanting to donate, please make your donations to Freedom Tree and I will be matching it up to $10,000. And I think we've actually achieved that, but if we haven't, that is okay. Go and make your donation. It is, I think you get a tax deductible receipt for anything over $20. So please do that. Help me. I think the program that I got into was building a school, which is super awesome to be able to say, hey, I helped build a school somewhere around the world I don't even know about. Okay, and then the last thing to just touch on, we are getting into our 6th year with the monthly mastermind. And so our next session is on the third Friday, which is on June 20th. So you can sign up. It is pay what you want, pay what you can, pay what you see value in. So attend and learn something super awesome in real estate. Okay, so let me stop the share because we are going to jump right into equity, and we're going to talk about return on equity specifically because you don't want to just have lazy equity. Yeah, one of those mindset things that I've been dealing with as a child, because if you're not moving, it means you're not taking action, and being lazy is sometimes okay. So, all right, so we are getting into this spreadsheet. So on this spreadsheet, you will see, let's see here. Okay, return on equity. So equity is one of those things that is often not paid attention to when you are doing calculations on your real estate investing, and it's actually pretty important. It's now the thing to keep in mind that it is not the same thing as ROI, two very different things, okay? So ROI is the return on your money that you invested in, based on how much money you're receiving from your cash flow. Okay, and of course, your cash flow is affected by the interest rates that you pay on your mortgage. Okay, so the ROI is calculated with your annual return divided by your total investment put in. And this number would include any money you spend on renovation. So keep that in mind. Okay, whereas return on equity is your annual return, but it's based on the equity that you currently have in the property. So two very different things. Okay, so we're going to go through a scenario here and we'll run through the numbers. And this is really important because usually we don't focus on our return on equity. And so that's one of the reasons why I wanted to do this. But the other reason is because I have a lot of conversations where I'm meeting new investors and they're like, Hong, I want to buy my second property. And so my first property, my primary home, I've got some equity in there. And I'm like, okay, great. How much equity do you have? Well, it turns out that, they might have put 5% down, maybe 10 or 20% down on their property. So really, that is the equity that you have in your property. But that doesn't mean that you can access that equity. That what you can access is what is allowed by the bank. Okay, so we'll touch base on what that is. So there's different types of equity. So here we're just talking about return on equity, but I want to point out that there is different types of equity. So the different equity, your sweat equity. So that's what you like if you're partnering up with somebody and you're doing the active work on that, that's the sweat equity. So that's the work that you put in to grow the value of that building. So sweat equity. So if you're not putting any money in and you're putting in your time, then that's considered sweat equity. There's the forced equity. So that's the same thing as forced appreciation. So that's the second one. So if you buy a property and you have to renovate it and that increases the value and somehow you can tap into that equity, then that's the forced appreciation, that forced equity. That's the second. The second one, which is very often over missed, is the passive equity, which is passive appreciation. That is the equity that really helps you grow your net worth. And a lot of people are like, well, Hung, it's great to have that, but sometimes we can't have it. So we don't plan for it, which is great. But then what they do is they then go into markets that have no appreciation or very, very low appreciation, which is not the best move. Like you actually want to be in a place where you can actually get a lot of equity through appreciation, especially passive appreciation, because that amount is also tax-free when you tap into it through refinancing. Okay, the fourth equity, which is also a lot of times missed, is the built-in equity, which is the equity that you have when you buy way below what the market value says. So let's just say the going price is $1 million, but then you buy it for 800,000. Well, then your built-in equity that is often overmissed in that situation is 200,000. And then you can actually go and potentially tap into that in some creative way. Okay, so those are your four types of equity. And so usually some of those are missed. So if you can tap into all four of that equity, that's super awesome. Okay, so what exactly is equity? And the funny thing is when I was writing my mortgage book, so here's my mortgage book, which you can buy on Amazon. I actually had misunderstood the whole concept of equity. And I had to get my business partner, Eugene, to actually break it down for me and explain to me and dumbify it down for me, which was super awesome that he did that. Okay, so that is the mortgage book, which is available on Amazon. So let's just say you buy a property for $1 million. Like I've got 144,000 here, which is not realistic unless you're in like a crazy location. So let's just say you buy a property here for $1 million. Okay. And I realize now that I don't have the down payment actually here, I do have the down payment. So let's just say, okay, you have a down payment here of $10,000. Okay. So this is actually your equity that you have in. Okay. So this is one of the forms of equity here. So that's your equity. Well, you go and you get a mortgage here. So your mortgage now is 990,000. So how realistic is that? Probably not too realistic anymore. So let's say here we're going to put in 100,000. Yeah. So 100,000. So let's just say your down payment's 100,000, your property is worth $1 million. So now you go and you get a mortgage for $900,000. Okay, so the bank or some lender is going to give you $900,000 for the mortgage, and then you pay that down every single month. Okay. So that is your mortgage amount. So now what is actually your loan to value? Okay. Now this is different from loan to cost, loan to construction, all of that. So your LTV is your loan to value. So I'm just going to make this a little bit bigger. Okay. So how do you calculate your loan to value here? So you take your 900,000, divide that by your 1 million. Okay. So your loan to value here is 90%. Okay. So that means that the bank is lending you up to 90% of your property value. How realistic is that right now? Not very. Okay. Because what's happening is that your deposit right now, okay, I'm going to put that over here so that you can see it, so to calculate that, you take your 100,000, divide it by your 1 million, which is your purchase price. So then that is 10%. And we're going to go this way. Okay. So if you're first-time home buyers, yes, you can potentially do that. So realistically, you're probably going to need 200,000 to make this purchase. So as you can see, the numbers automatically change. So your loan to value here is 80%. Now, this is super, super important because it doesn't matter if you're buying the property now, financing, because what happens is the banks will go to a max number of LTV in total for all of your mortgages. So in this case here, we're just talking about one mortgage. But let's just say now you go and you get, so you have a mortgage one, okay? But let's just say you go and you get a mortgage two, okay? Well, the sum of this, mortgage one and mortgage two, equals the total of your loan to value of 80%. So what's happening now is that as you pay down your mortgage one over the years, this 80% will go down and your equity will actually go up, okay, which is the normal process. As you're paying down your mortgage, your equity goes up. So then when you go to refinance, the banks right now will actually say, well, we're not going to go up to 80% anymore. We're only going to give you 65 or 70%, which now means you have more money tied up in your property. So now this equity or your down payment or your equity, okay, or this lazy equity is what some people call it at. Okay, I like to call it dead, like completely dead equity, because if you're not using it, it's worse than being lazy. Okay, it's like, you might as well just be dead then. Okay, so if you cannot tap into this down payment, then that means you have money that's sitting there that's not doing anything. And that's an important concept because to grow your net worth, you want to be able to tap into this lazy debt equity as much as possible and leverage that. Okay, so let's just say here that you buy a property for $1 million, you have to put in 50,000 for the renovations. Your down payment is your 200,000, so we're going to leave that. okay? Your mortgage is 800,000. Now the way to calculate the mortgage amount is your 1 million minus your 200,000. And don't make it more complicated than that. Yes, I know you can potentially get a mortgage plus improvement mortgage. Okay, in this case, we're not calculating that. This 50,000 comes out of your pocket. So it does form part of your ROI calculation if you're calculating ROI. Okay. So now in terms of, okay, so now let's just say you purchase this and then a few years go by and then now you've paid down your mortgage down to 500,000. Okay. The current market value now is 1.8 million. So that means that, time has passed. You've seen this passive appreciation. So I'm just going to type that in for you so that you could see that that's passive or um, natural appreciation. That is the word that I'm looking for. Appreciation. Okay. So this is also a form of equity here as well. Okay, so now you have, okay, now your annual cash flow is $200,000. No, sorry, 20,000. So this is your annual income after you pay off all your debts plus your any debts like mortgages and private lenders or whatever you have on that. Okay, so not the greatest situation to just be making $20,000 on a million point eight. Yeah, 1.8 property, you actually want to be making way more than that. So now let's just say you go and you tap into a $700,000 $700,000 HELOC, okay? And that is what my recommendation would be, is that if you've got this property with this much equity available in it, look at selling it if you want to, but I would actually suggest holding on to it and tapping into the equity through a HELOC product and leveraging that HELOC. Okay, so let's walk through why I'm making that recommendation. Okay, so the ROI calculation is your C12, which is your cash flow, so 20,000 divided by your initial investment plus any renovations that you made. Okay, so that's 250 in total. So 20,000 divided by your 250, and you've got an 8% return on your investment. And now this is a one-time snapshot. So if you are saying, well, Hung, you know what? I've made way more money than that. Well, you need to figure out what your annual return is, which is what we're using here, the 20%. So this ROI is an annual return. Okay. It's just like a one-time snapshot to say, hey, I'm making 8% on my money, which is great. Ideally, you want a little bit more than 8%, but 8% in this case is really good. Okay. Now, the return on equity. Okay. Now look at this. It's only 1.5. That's totally sucks. Okay. So to calculate this, you take your 20,000 that you're making, and you're going to divide it by your 1.8 million minus your current mortgage. So you're dividing it by 1.3 is in essentially. Okay. So that's how you get the return on equity. Now, this is without the HELOC product. And the reason why I showed the next step with the HELOC is because it does increase it. Like it actually doubles. Like if you look at down here with the HELOC product, we're actually doubling it. Okay. So right now, without the HELOC product, you're sitting on equity of 1.3 million. That's a lot of money to be sitting on without doing anything with it. Now, there is an argument to be made about sitting on this equity because one, when you have this equity, you can now use that to do other things besides getting a HELOC. You could sponsor loans. You can protect yourself from crazy economic swings like the one we're in now. Because when you have equity, you have borrowing power. You have safety. Like it's a safety net because now you're not over leveraged. Okay, and it's funny because if you're sitting right in front of me, you would actually, I would actually be spitting on you. Okay, So this equity, this debt equity that you're sitting on is part of that net worth that you would be calculating into your net worth statement. So it's not all that bad of a thing, because the minute you go and leverage it through a HELOC, well, now that's debt. That's going into your liability line. And so your net worth would actually go down quite a bit. But here's the thing. If you tap into this 1.3 and you get a HELOC, your return on equity goes up. It doubles, okay, to 3.3. So now how is that calculated? You take your 20,000, divide that by your current market value minus your current mortgage minus your new amount that you can access through your HELOC. You take all of that, and that's what you divide it by. And so your return on equity now is 3.3. Now, if you can tap into more equity, so let's just say your equity goes up to your HELOC. If your HELOC goes up to, let's see, yeah, you could potentially go up to 1 million. So that's 10 million. So we don't want to do that. We want to go into 1 million. So now your return on equity is actually 6.7, right? So you've actually like 3x'd it or 6x'd it, depending on how you want to look at that. Okay, so now this only works if you take this 1 million. So I'm going to go back to 7 just so that we're not talking about 1 millions somewhere, so there won't be any confusion here. So let's just say you tap into this $700,000 HELOC. Okay, you want to give that HELOC a second job. It's not just a HELOC for you to sit on, and if you use it, then you pay interest, right? It doesn't just sit there being lazy and potentially getting this 3.3. You want to take this HELOC and actually give it a second job, which is like that concept of the golden goose. Okay, so if you don't know what the golden goose is, go and watch my other video on what the golden goose is. Okay, so you want to give your HELOC a second job. So let's just say you take that money and you can go and you can make 10% on that money, either through private lending, through stock investing, investing in a business, buying another real estate property. It doesn't matter what that avenue is, as long as you do something with it and you see a consistent 10% return. Okay, so now you're going to make an extra $70,000 a year. That's amazing, because this is somebody's income for the year. Like, you're basically making this very passively, depending on how you want to make that money. It could be super, super passive. Okay, so you're making another $70,000. So now your new net cash flow is 90. So this 90 is taking your original 20,000 from your first property plus your 70,000 that you're seeing now with your HELOC money. So now you're at $90,000 for this one property because you're leveraging it. Okay, so your total equity here now is your 1.8 million minus your 500,000 in your original mortgage, okay, your current mortgage balance, plus your HELOC amount. Okay, so now look at this. Your new ROI based on this, if you're able to get access to all of these HELOCs and products and stuff and get the 10%, your ROI now is 15%. Okay, so how did I calculate that? So you take your 1.8 million, no, sorry, you are dividing your 90,000, because now your total income for that year is 90,000, not the 20. So 90,000 divided by your 1.8 million value minus your current mortgage of 500 and minus your 700,000 in your HELOC that you owe. Okay, so that's how you get your 15% return on investment representative for this year. Now look at this as well. Your return on equity is also at 15%, okay, which is super huge. Like, you're basically going from 1.5% return on your money to a 15% return on your money. And this is without selling the property. This is just leveraging it. Okay, so if that is not an aha moment for you, because for me, this was massive. Like, every single year for a very long time, like even this year, I was having the conversations with other investors about whether or not I should sell some of my properties. because of this particular situation where I'm sitting on a lot of passive, natural, dead, lazy equity. And it turns out that, you know what? Regardless of the interest that I'm paying on the property, if I can tap into this HELOC and make it work, a second, third job, then keeping it and rolling it into the next generation, it makes way more sense. Okay, so I'm hoping that that is clicking in for you as well. Okay, so let me just make sure that I've covered all of my notes here. Oh, equity. The other type of equity that we did not talk about is the equity in joint venture partnerships and GPLPs and shareholders. That is a different type of equity as well. Okay. Oh, loan to value going down. So we did touch a little bit on that because when your loan to value goes down, that's a bad thing. Okay. So yeah, it's like, so for example, like in Fort Mac, where the property values shot down, right? Like if you buy something for 1 million and then the value goes down to 750,000, well, then your loan to value has completely changed. Okay. And that is like, and you don't want to be in a situation like that. You will actually have your loan to value will actually be higher than what your value is worth. And that's not a good situation to be in. Okay. So this loan to value is what the banks will allow you to access in terms of additional funds and mortgages. So it's sort of like the ceiling as to what you can tap into. Okay. So yeah, so we talked about getting the appraisal done in the future because if your appraisal comes back lower than what you thought it would be, that will definitely affect your loan to value, which is a bad thing on your equity. Okay, so I think I've covered everything on my cue card here. So, okay, so if you have any questions about this, please don't hesitate to reach out to me. I am here to provide answers to questions on everything about money matters on real estate. All right. Thank you again for watching, everybody. And just one last reminder, if you are in wanting to, oh, did I close it? I might have shut it down. Oh no. Which of, oh no, here it is. Okay, so just one last reminder about our monthly mastermind for the yeah, for the monthly mastermind happening in June, and we will be holding it through the summer as well. And if you are able to make a donation to match with Freedom Tree, because my company will be matching up to $10,000. Woo, that's a lot of moolah. $10,000 for building a school to Freedom Tree. So please make a donation if you are able to. Okay, thank you for tuning in, everybody. My name is Hung Lu, and I am with Cash Property. Have a fabulous week. Thanks, everybody.